Andrew Holland joins us now, represents Ambit Investment Advisory. Andrew, morning. Thank you for joining us. Andrew, looks like we are getting twisted from all the sides. Globally, it is Greece, US, and now China. Locally, first it was rupee, then earnings, now it's GDP.
Yeah, you've depressed me already by reminding me of all the factors that are out there, which are so negative, and trying to think through how can it all change. Well, let's start off. I don't think the US is as bad. I mean, the figures, continue to let the economy trundle along, so I'm less concerned about that. Greece has really kind of been demoted by Spain in terms of where the worries lie at the moment, and obviously that's a much bigger worry for the European banks and politicians and everybody, because it's so huge. And of course we have the Greece elections in the month of June, so we could have a lot more volatility over the forthcoming 2 weeks ahead of that vote. But I think Spain is the one to look at rather than Greece now. And there's many different scenarios going around in terms of what could happen in Europe, even to the point where everyone's saying all the European nations should just go back to their own currencies. I'm not sure what that would mean, but in a worst case scenario, obviously that would be have a lot of financial turmoil for everything globally, and we could see markets fall. I'm hoping that's not the case, but even if things get better in Europe, or there's another kind of quantitative easing, I'm just wondering now, whereas a few weeks ago I would have said India would benefit or enjoy that kind of liquidity rush, but yesterday's figures, if it hasn't sent alarm bells ringing in the government, then I don't know what will. At 5.3%, you can only look and say, well, okay, earnings are going to be under pressure. We're going to see more earnings downgrades for India, and the FIIs have actually kind of sat on their hands for the past 4 or 5 months, and after investing in the early part of the year, I don't think it'll take much for them to move out now.
Andrew, what's the biggest concern for the market looking at the GDP shocker yesterday? Is there a lingering fear as to how many more GDP slippages we may see in the quarters to come, or do you think at 5.3 it's bottomed out?
Well, I think we're getting into that problem of what to believe, and if you take what's happened in Europe, many politicians have come out and said the worst is over. And I think we've heard that quite a number of times from the finance minister saying the worst is behind us, whether it's inflation, and now he's saying the same about GDP growth. I don't think anyone's believing it, because no one's seeing any action being taken. So what will happen is that everyone will disbelieve what's being said, and therefore we just spiral down because of that, because everyone's sitting on their hands. So I think we could be in for more shocks rather than surprises, unless the government actually wakes up and starts to do something. And I think that's what the markets will be watching very closely now. And if there's inaction in a global environment which in itself is very shaky, then I do believe FIIs will start pulling the plug and say, we'll come back here again when we can see actually some real policy reforms and move by the government to shore up the finances.
Andrew, let's discuss banks. Now, one school of the thought is that if GDP slows down, that will have impact on the investment cycle, that will hit consumption, and then that will hit banks. The other side of the equation is that GDP is slow, and Reserve Bank of India will now be prompted to announce another rate cut in the June policy. Which side of the argument you're on? Are you bullish on banks, or are you bearish on banks based on GDP data?
I'm bullish on the quality banks. I think the likes of HDFC, as we've mentioned many times, will grow at the same rate in good markets and bad markets. I mean, they will be affected, don't get me wrong. But it goes without saying now that all the concerns on the banking sector in terms of non-performing loans, restructuring loans, are going to resurface. All the banks which produced pretty poor results are going to continue to perform badly. So I think the banking sector is going to be split into the good and the bad, and the bad are just really going to have big problems going forward. So I'm of the view that interest rates will be lowered, and I think that's probably why the banking sector will probably hold up in the very short term. But there's a great trade. You buy quality and you short the weaker banks, and I think that's going to play out very nicely over the next few weeks.
But Andrew, if we were to deteriorate further, if inflation is going to increase and growth is going to slow down, and if we indeed have a stagflation sort of scenario building up, which already seems to be the case, do you think in that case the policy action is going to be stricter, and perhaps that makes a case for sharper rate cuts, or no?
It can't just be interest rate cuts, because that helps at the margin, but it doesn't bring back confidence. It doesn't make you go out and build a new plant if you can't get the land approvals. So what really the government has to do is work on the subsidies, which we all know they have to work on, and have some reform there, and also excite corporate India back into private investments and attracting capital from overseas. So those are the two elements they have to achieve in the very, very short term, because some of these factors won't play out for the next 2 quarters or so. So you're going to have 1 or 2 quarters of very, very slow growth in India, and hopefully the government will take the action to arrest that going forward into the second half of the year, and that's what we've got to see. Otherwise, India, whether you have a good scenario in Europe or not, is going to be off everyone's radar. And the India story that we've all been talking about, and I've been talking about since 1997, we're going to have to reinvent again, because guess what? No one cares.
Well, just like the Economic Times today is reporting, it's time to say goodbye 2020, but say hello to 1990. Andrew, do you think for the month of June, the biggest joker is not global, but it is monsoon? As of now, markets are pricing in an average and a healthy monsoon, but if things don't move as per expectations, autos, FMCG, consumer names, they could take a whack.
Yeah, I mean, fingers crossed. So there's not one extra negative being thrown into the pack of cards. So yeah, I mean, it could be negative. I mean, I'm not a weather forecaster, and hopefully will never be. But if that proves to be the case, then your story of lower growth, higher obviously food prices, stagflation, just exacerbates itself even more, and would require quite a lot of government action, of which no one's seen for a very long time. So you're calling upon a very optimistic view to say that all of these things will be arrested very quickly.
Low growth, high inflation, stagflation, that's the economic term, and that's really the worst period to have. So Andrew, what is the good news here? We've been bearish for the last 10 minutes. We've discussed all the wrong reasons. Why there is light at the end of the tunnel?
I think there is always light at the end of the tunnel. Sadly, you have to work out and say how long is that tunnel. We might see the light, but the tunnel might be a long tunnel. The two scenarios that we're thinking about is one, a Europe which comes through the problems that we see, which is very difficult at the moment, but obviously it's a liquidity event both in Europe and the US and probably the UK throughout June, which will obviously mean that the risk on trade can come back, and India might be a beneficiary of that. I think less than it would have been before, but certainly would be a beneficiary. So that obviously gives you a good buying opportunity in the next for the month of June. If the worst case happens that Spain and Greece, the story unfolds, which is more ugly than we expect, then obviously all global markets, the risk off trade will continue, and our markets will fall, and our market could easily fall 10 to 15% in that scenario. That would bring it down to levels on a PE price to book that you've not seen since 2003, 2008. and that would be a good entry point. So whichever way I'm looking at it, you're going to get some reasonable opportunities to make money on the upside. It depends on how good or bad that scenario in Europe pans out. I'm not taking away the problems in India, but I'm just saying how the global sentiment will affect India and the opportunities to buy within those two scenarios.
Sectorially, Andrew, autos, that's been a weak link, even though, every individual story has been pretty divergent. But do you think the weakness or degrowth concerns are valid when it comes to Tata Motors as well as Maruti?
Well, I think there's two different stories here. One, Maruti, obviously you've got to look at the rupee to the Japanese yen, and that's not working in favour of Maruti. So, you've got slower sales growth, you've got higher input costs, margins get eaten away by that. So that's a margin contraction story for Maruti. Obviously with Tata Motors, it's all about China, and obviously, people put their funds down to the growth story for Tata Motors in China for the time being. But I think the valuations are starting to look interesting for both of them. I don't think it's time, when sentiment's so negative, to be jumping in and buying heavily. But I think nibbling away at these levels is not a bad thing, because I think these two companies will continue to do well, both domestically and overseas as well. But it's a longer term story. It's all about entry points. I think we're getting close to those entry points at the moment to start nibbling away and buying.
Andrew, I read a report in the morning from the House of Macquarie, and where they are of the view that the true value for HUL, which is Hindustan Unilever, is 600 rupees. I read a report yesterday from another foreign brokerage report where they are of the view that Asian paints from these levels could appreciate by another 50%. On Monday I had a report on TTK Prestige where they expect TTK Prestige could appreciate by 40% from these levels. Is there a potential bubble in making in some of these consumer names?
Well, you've mentioned three different companies, and whilst I would say that Hindustan Unilever, I don't think is a bubble in the making. I think it's easy to say what are the two sectors that you hide in. One is obviously consumer stocks, which you've mentioned, and pharmaceuticals. And the debate has been, do you pay these kind of high PEs? For the kind of growth ratio you're getting from them. I've always viewed the basis that the domestic consumption story in India will continue. It might slow, but it will always continue. So therefore, the PEs you pay are pretty reasonable given the decades of growth you can expect, for India and the rest of Asia going forward. So I'm less worried about these. I wouldn't say that I'd be saying I'd get a 50% return from these stocks in the very short term. I think that's pushing the story a little bit too hard. But obviously, if prices do move higher, expectations remain very, very high, and that's where you could have expectations not being met and seeing share prices fall. A la Tata Motors the other day, I think expectations were very high. It didn't meet them, and he's probably done a very good job, but it didn't meet expectations, and the stock just gets hammered down.